Hello my fellow traders, this is Scott N, and this video is about how to risk properly when you are trading. Most traders do not learn about how to risk when they start trading, and even if they do learn it, they don't follow it. It's usually the last thing they learn, but before learning anything else, it's probably the first thing they should learn. Most traders do not run into problems with either consistency or blowing up their account because of the setups or methodology they use at all. Almost always it comes back to how they risk. First, I want to say that this is my way of approaching risk. It certainly isn't the only way, but it works for me. So you can take what I have to say here and adapt it to your own style. But I think the concept I'm presenting is a universal concept, and I think it's absolutely critical to your long-term success as a trader. Also, a lot of people talk about risk and stops, but I think most of the time the details are missing. And I believe the devil is in the details. Alright, how to risk. For the purposes of this example, I'm using a $30,000 account size, but all the numbers I talk about are based on percentages. So just take the percentages I use and apply it to your own account size to come up with the equivalent dollar amounts. I should say here, these parameters are appropriate for day trading. For swing trading, things would be a little different because you're dealing with a longer time frame between trades, but not that much different. So let's get into it. Whatever your account size, there should be a maximum amount of money that you will allow yourself to lose each day, period. You decide what that amount is, and it should be an amount that if hit during the day, you will not be bothered or affected by it that day or going into the next day. But it's not only a matter of an amount that you're okay with, it needs to be realistic, a realistic max loss number. What do I mean by that? Well, if you're trading, you will have losing days, right? Of course you will. We all do. Well, what if you had a series of max loss days in a row? It can happen, and if you're trading long enough, it will happen. So you want to pick a max loss number, percentage number based on your account size, so that if you have a string of max loss days, it will not damage your account so badly that, one, it's going to take you a long time to recover from, and two, it's not going to damage you psychologically to the point you will not be able to trade or trade properly, or you do all kinds of crazy things like revenge trading, which leads to more problems. So this is how I recommend most should do it. Your max daily loss based on your account size should not be over 3% per day. However, I should say if you're not consistent, that number should be much less. Heck, it probably should be as small as possible. Or maybe you should still be on a demo account, in my opinion. Now, some traders only trade an average of 1 ticker per day. I shoot for an average of 3 simultaneously, or up to 3. This is really important because if your max loss is 3% a day, which is $900 on a $30,000 account, and you trade 3 tickers, you should only allocate about $300 of risk for each ticker. If you're only going to trade 1 ticker, you can allocate the whole $900 to that 1 ticker. If you're going to trade 2 tickers, then you can allocate $450 of risk to each of those 2 tickers, and so on. But that's up to you. Once you define how much risk you can allocate on 1 ticker, then the next step is to plan your trade and work into that risk. And that means that if you might have one specific entry in mind, so you're going to enter those 900 shares and either hit your first target or get stopped out and you're done. Or maybe you think you might miss the trade and it's already moving away from you, so you decide to take a starter position with 200 shares and pick 2 other areas you would want to enter and will leave limit orders for, say, 350 shares each at those entry points. Now that everything is in order, you know what your total max daily loss is, you know how much that total daily max loss can be divided up among the number of tickers you will trade. And finally, once you have identified a trade, and you will plan your entries and further divide the risk allowed on that ticker by the number of entries that you make before your stop is hit. So hopefully that makes sense to everybody. I'm just going to get into a real life example. So okay, so let's use Broadway Financial. The symbol's BYFC from Friday, June 20th. Let's say you've been watching this all day. It's overextended after a big morning push. You think the top has been set. It's going to come down. The top is set at 725 and it's grinding near $6. You're using $450 for your risk, and now you need to plan how you'll enter this stock. Now, you could enter at 608. Say it's grinding in this area. You enter at 608 and you might feel pretty confident and you want to risk to 650 because there's a resistance area there and you don't think it's going to go back and test the high again. If you entered at 608 and you're risking there, then, or actually if you entered at 608 and you're risking this to 650 is one option. You could also enter at 608 and risk above 7.25. So there's a trade-off there. If you entered at 608 and you're risking up to, say, let's say you use 730 as your risk, you could, if you do the math, you could size into 370 shares. Or you could enter full size at 608 and risk to 650. That's plausible too. If you do that, you do the math on that, you can get 1,070 shares. So it's 370 versus 1,070. Same risk, same dollar risk. Well, what's the trade-off there? I can think of two. There's more profit potential by having a tighter risk because you have larger size. If it goes your way, you're going to make more money. But maybe you have lower odds doing it that way. And maybe there's more stress. Maybe you'll be under more stress because you have a tighter stop. You not only have to manage the trade, you have to manage yourself and your psychology. So there's a couple ways you could do that. You could also decide to use 650 as your risk, but only enter half your size. Instead of entering the full 1,070 that you calculated, maybe you enter 570 and then you put a stop market to enter on the short side, or stop limit, say around 579 to get full size, risking to 650, because at this point then the odds probably are more in your favor that this trade is going your way and you probably won't get stopped out at 650. So this is where the planning comes in, and it isn't an exact science, this part. The math up until this point is, but planning is more of an art. But if you have your plan and you have your set risk, whatever the outcome is, it's okay. I could spend a lot more time on this subject. I probably will later, but I think I got at the heart of it, and if you have any questions about it, just let me know.